Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time December 2023. I hope your holiday preparations are going well. I'm a little bit behind with things my wife tasked me to. I'll get to it this afternoon. Hopefully she's never going to watch this video. But before I do that, I wanted to record a quick market update for you because we got some interesting stuff to talk about today. Normally this time of the year, I like taking a step back and reflecting on what happened this year, what happened with the market, what happened with our team, and where we're going next year, what's the outlook for 2024. And then also we have seen some very welcome changes. Mortgage rates have been coming down nicely in the last 6 weeks. But we actually had some major developments in the last couple of days that has to do with inflation, with rates, with what the Fed is doing. We'll talk about this today because this is going to be potentially or probably a game changer for us for 2024. And it is what we call in the industry an inflection point. So an inflection point is if we were going in this direction for the last 1 or 2 years, and as of today, we're going that direction. So that's the topic for today, but before we get there, let's take a quick look at the latest data from the MLS. So November numbers here. Inventory is up 3,372, up compared to November of last year. Still very low compared to a benchmark year from 2015, which was the last year we have seen a normal market, but it is up, and the significance of this is that it is up higher now than we started the year out. So this is not typical for the season. This is actually a trend that is very interesting. And we will have to talk about this a little bit more. Closed units are kind of normalizing, still down a little bit, but we're getting there ballpark where we should be. Days on market, very normal for the seasonality. So the market is losing velocity. It takes longer to get a house under contract, less competition. So this is also very much in line with what we typically see around this time of the year. Same with the prices. So this is the first time in about half a year that we were below 300,000. This is normal, a seasonal pattern. That we see prices coming down in November and in December, but we're still 7.2% ahead compared to last year of November. And I think we're going to probably finish the year right around the 7.5% mark. So we will, in a month, I can tell you what it actually ended up with. But November was a very interesting month. It provided a lot of good opportunity. We have 9 closings on the book for December. Those were all deals that got negotiated in November, and some of them were actually pretty good deals. Its inventory is sitting a little bit longer on the market. You don't have as many new listings coming on the market anymore, but you have more and more listings that didn't find a buyer. Maybe they were priced a little too high, condition wasn't there. So for whatever the reason, they're sitting a little bit longer, and that creates, of course, an opportunity and some motivation to give concessions on the price level. And this is why you're seeing this time of the year prices coming down. Sellers want to make sure they sell their property before winter finally hits and we get snow on the ground. Interest rates have been coming down nicely over the last 6 weeks to the point where I had some conversations with clients in the last few days and they're like, wait, interest rates are what now? So that's really good news from the rate end. And on the surface, you might think that interest rates are impacting buyers, but they're actually also impacting sellers, because we know from the data about 70% of all sellers, of course, have to go somewhere. They're also buyers, and they're potentially moving to a more expensive house, and they're going from a 3% mortgage rate to maybe 7, 8, 8.5% rate. And of course, that is a big step that many of them did not want to take in that high interest rate environment. So what has happened this year is we have seen demand coming down because of the higher mortgage rates, but we have seen supply coming down even more. So we still had maintained this imbalance. Although the overall transaction volume was greatly reduced this year, we still maintained that imbalance, and that it was keeping pressure on the prices this year. Let's take a look on what this looked like over the entire year. So I have here a few select months: February, June, August, and November now. And you can see what happened with inventory. We started out with only about 2,295 units. And throughout the year, inventory has steadily improved. Normally, we should be ending up the year with about where we have started it, and that's not the case. we're seeing more and more inventory. And I think the rate lock effect is easing up a little bit. Maybe some of the sellers, they had a reason for moving in the first place. Usually it's a life-changing event, so it's not like all of a sudden they wake up and say they want to move. Usually there is a reason why they need to move or should be moving. And maybe it's getting to the point where they're just saying, you know what, we've been waiting long enough. Let's just do this. Maybe also the easing on the mortgage rates had to do with this that we have seen in the last weeks. Whatever the reasons are, we're seeing more inventory now, and that's good news for the market along with the lower rates. In terms of velocity, this is a very normal, typical seasonal pattern, although the entire year was crazy fast compared to, historic standards. We started out with 16 days, then we peaked in spring with 5 days, which is basically as low as you can physically get on the MLS. So I don't think we will ever see 4 days on market. That's just extremely fast. And then over the summer month, velocity was coming out, and now in fall, November, we always have this situation where things taking a little bit longer, and that provides pretty good opportunity. Now, when you look at prices, you see that we've started the year very, very aggressively. Buyers were really trying to get into the market as soon as inventory was coming up. This is what causing prices to jump up to 275 right away. Then, of course, the spring market did what it does every year. It drove prices up to almost about 335 is where we peaked, I think. And then we're seeing a little bit of a moderation. By the way, the increase here compared to June before is not as big as the early spring had indicated. So that was an interesting development, and I attribute this to actually how mortgage rates were rising. Back then we were thinking 6% is high, but then all of a sudden we were talking about 7 and 8%, and that really put a damper on pricing here. So buyers were trying to negotiate the best they could with the competitive market to let prices not go up too much. And now towards the end of the year, we're coming down. This is a total normal seasonal pattern, and this is what we typically see around this time of the year. Before we're getting to the big news, if you're not familiar with me, allow me to quickly introduce myself. My name is Marcus Auerbach. I'm a seasoned real estate agent with Keller Williams, and together with my team, we're working a lot with buyers and with sellers in the Milwaukee metro area. You can probably tell by now I'm a very analytical and data-driven guy, and real estate sometimes gets a little bit high on emotions. So I believe it's very important for our clients to make good, sound decisions. They need good, sound information to base that decision on. And that's basically how we are approaching the business. Funny story, I recently was in Wauwatosa locking up from a showing, and the lady's approaching me. Is like, hey, you're the guy from the internet. Thank you so much for making these videos. You've been helping us. Really, we just wish we could have been working with you. And I'm like, apparently I have not extended an invitation, so please consider this your invitation. If you want to have a chat with me about your real estate plans for 2024, then feel free to send me an email. From what I understand, a lot of people are looking me up online. They're looking at my Google reviews or Zillow or Realtor reviews, and then send me an email. You have my email address here, m.auerbach@kw.com. Or if you want to, you can just hop on my website, onpointrg.com, and there is a button on the top right that says schedule a call, and you will see my personal schedule there. You can see when I have openings, and you can just grab one that works for your schedule, and then we can hop either on a quick phone call or on a quick Zoom call, whatever you prefer. So looking very much forward to hearing from you, and with that, let's hop back at the data. Inventory is probably the most important metric when you analyze any real estate market. This is why it's always the first number that I have in my monthly market update. And the reason why it is so important is because inventory is the net bottom line results of the forces of demand and supply working together in the marketplace. The net result is inventory. So if supply is low and demand is very high and the buyers are buying up all the properties quickly, the net result is low inventory. And this is exactly what we have seen early this year. We started with very low inventory, and then we went even lower as buyers were picking up basically everything that came on the market. What's remarkable is that inventory is building up here towards the end of the year. Normally we should be about the same as we started the year. So this is interesting, and this makes me hopeful that we're actually going to see more inventory in 2024. Now, when we look at new listing inventory, so this is what comes on the market every month. Normally the blue line total inventory should be much, much higher than the green line. So there's a few new listings adding to the pile, but the total number of inventory should be like 10, 12,000. But you can see the lines are almost they're intersecting, they're overlapping, which basically means all the new inventory is getting bought up more or less in the same month. And that is trending down now. That is seasonally normal. Very few people are putting the house on the market in December unless they don't have a choice. So I think we're going to see new inventory trending down for the next couple months. And then the overall inventory is probably more or less going to stay flat. Let's take a look what's happening with the sold to list price ratio. So this is basically how much buyers are paying over or under the seller's asking price. And as you can see, we were heating up in the summer very much. 100% is here. So anything above the 100% line means that buyers were paying more for the property on average than sellers were asking. And this has been coming down nicely. Also, this is a normal seasonality. So it's great to see that after the somewhat unpredictable COVID years, we're back to a normal seasonal pattern here in Milwaukee. What I just underestimated is how strong the demand is. So last month, I was predicting that the sold to list ratio is going back down to below 100, and that actually did not happen. We are still just a little bit over the 100% line, even for November, which is normally a market where you can negotiate discounts. And so I think we're going to see a result that is going to look more like this. So we're probably going to stay here. And then in the beginning of the year, we're going to perk up again, and we're going to be in very competitive territory very quickly. Just a repeat of this, what we have seen here the last year. Finally, let's take a look at sold prices. So these are comparables. This is transactions that have closed. This is very typical going up in the spring and summer market here. That's our peak market, and prices are trending down now. The main thing is you can see that we're coming down, but we're still significantly higher than we were, and we are kind of flatlining here. So it looks like we're done with prices trending down, and that is also an indication for what's going on next year. Last month, I expected that prices would come down more if you look up my last month's video, but the new expectation is, I think, that I was a little bit too pessimistic, if you will, with the prices. I think we're going to go sideways from here. And then in the first quarter of the year, we're going to see prices kick up relatively quickly. Another very important metric that helps you understand how hot or how competitive a real estate market is the percentage of homes that sold above asking price, above list price. And this is a question that comes up all the time with buyers. They say, hey, there's 5 offers. What do you think? How much over asking is it going to get? And with sellers, they say, hey, if we list the property at this price, do you think we're still going to get offers over our asking price? And this chart here gives you kind of the answer on a high level. This is all the way back to 2015 to today. And the red line is showing you the national average, kind of as a reference point. And the green line is Milwaukee. You can see that in Milwaukee, the percentage of offers written over or properties sold over list price is actually higher than the national average, which goes to show how competitive our market is. When you look back here, so what's a normal in a historic sense? About 20%. So that means 1 out of 5 listings will actually sell over list price, over asking price. So that used to be a really big deal. But you can see, because of supply and demand, how Milwaukee is actually outperforming the national market. And the last 3 years have been pretty much here in the 60 to 70% range. So about 2/3 of all listings in the Milwaukee market during the spring and summer market have sold over asking price. And you can see here the impact of mortgage rates. If I bring in here mortgage rates, you can see as rates were running up here, you could see how that almost broke the demand. It really had an impact on this, but the market recovered, bounced right back, and buyers basically shrugged it off and said, you know what, we want to buy a house. So this is a very strong testament for how strong and resilient buyer demand actually is. Even now that we're in the 6, 7, 8% mortgage rate territory, we still were this year with 2/3 of all listings sold over asking price. So very important indicator. Let's take a look at inflation. Consumer price index came back very good a few days ago, 2 days ago, at 3.1%. So, you know, this is the 5th month in a row where we have low numbers on inflation. That's actually really good news. And that is also, of course, impacting the rate policy, the monetary policy from the Fed. I had to change my slide this morning because a few days ago, Jerome Powell actually said they're leaving rates unchanged. They wanted to see this play out. And as of this morning, that's the big picture here, Federal Reserve keeps key interest rates unchanged, which is kind of what we were expecting. But I was blown away that he would actually go on record to say that he's expecting 3 rate cuts in 2024. So, of course, the bond market has reacted right away. And if you look up 10-year Treasury bond, you will see what I'm talking about. And I'm going to explain it in a second. So this is where we currently are with mortgage rates. So you can see the last 6 weeks, we've been dropping really sharp. This data is actually a week old. The chart wasn't available as of this morning. I think it will probably be somewhere like down here. So we're definitely in the 6s now. We're not in the 7s anymore. I've checked several banks this morning. They're between 6.5% and 6.8% here with the local banks in Milwaukee. So what are the big guys forecasting? We have here Fannie Mae, Mortgage Banker Association, and the National Association of Realtors. And I think these guys have been too optimistic early on. They said, inflation is short-lived, rates will come down quickly. And I think now they're being too pessimistic. The most optimistic one of the bunch is the Mortgage Banker Association, forecasting us to be in the second quarter, which is April, May, June of next year, to be down to 6.6. If this is going to continue at the same pace we're currently, then we may reach this before the end of the year. Who knows? Mortgage rates are notoriously difficult to forecast, but there is some math and some logic behind it, because you always see how mortgage rates are trending the 10-year Treasury yield. So that's the blue curve, and the mortgage rate is kind of like riding on top of that. So there's always a typical spread of about 1.7%. And that is because investors are perceiving an investment in mortgage rates or in mortgage-backed securities as more risky. So they want to get a little bit higher return on their money than if they would invest in US Treasury bonds. And that risk premium that the market is usually asking is about 1.7. And at the moment, we are quite a bit higher. We're currently at 2.7. And this chart just shows you how big the spread is. And you can see whenever the spread was going into that 3% premium for mortgages, it didn't remain very long. And it looks like we're getting out of the woodwork here, and this spread is dropping down. So investors are saying, you know what? I'm content with a lower premium on my mortgage-backed securities compared to the US Treasuries. Now, so we have that premium coming down, and on top of that, we also have Treasuries coming down. So we're getting the double whammy effect. This is why rates are dropping so quickly. So we've already established before that the change in mortgage interest rates impacts buyers and sellers, and with that, it really defines the direction that the real estate market is going to take in 2024. Nobody can really tell where rates are going to go, but at the moment, the trend is actually going down. And there's a lot of studies that say that 6% is kind of the threshold psychologically for a lot of buyers and a lot of sellers in the decision making. So, coming from 8.5% mortgage rates, when you're all of a sudden looking at 5.99, a lot of people are saying, you know what, it's time to make a move. Anything below 6 is perceived as very attractive at this point, according to these surveys. Of course, we might also see rates going sideways or even higher, and then, of course, that would not be good for the market. Now, talking about big picture, what's going on with prices? And I want to zoom out here and get away from the month-to-month pricing and show you a little bit the big picture. On the left side, you have a map of the US that shows you price changes in basically the last 32 years. And you can see in dark blue, those are markets where real estate prices have gone up more than 500%. And it's interesting to see because we have all these West Coast markets. We have the southern markets here very strong. We have Florida very strong. And some of the East Coast markets up here as well. And then when you look at Wisconsin, we are below the national average over the last 30 years. 284% real estate appreciation. Now, when you compare this with actually a chart from 2023, data is from CoreLogic, you can see that Wisconsin is really sticking out like a unicorn here. Together with the Northeast here, we are one of the few markets that has really seen strong appreciation this year. And guess which ones are the markets that are performing low, and they've been very gentle here with saying less than 1%. There should be actually a negative scale because Austin, Texas, for example, has seen a 10% loss in real estate values this year. So Austin, Texas has been one of the high-flying markets. They got like 30-40% appreciation every year. And of course, now they're coming down. So all these markets are correcting. We're also seeing a lot of people moving around the country. Money always flows where it can buy the most. And because Wisconsin real estate prices are still relatively low, I think we're seeing more of a movement of more of a balancing act. Where the markets that were really high, they're coming down. The markets that were really low are coming up. So everything is trending more towards the middle, and people are moving where they can get more housing for their money, if that makes sense. So this is kind of a big picture trend. And you can also see that here when you look at the median sales price per square foot. So, that takes small houses, big houses out of the equation because it's price per square foot. And again, we have here national in red compared to Milwaukee in green. Milwaukee had a relatively conservative and predictable price curve here, or price change over the last years. But the gap has opened up quite a bit. We have now a 28% difference. Milwaukee would need to go up 28% only to catch up with the US average. And historically, this used to be 16%. Now, I will argue that Milwaukee has become a lot more attractive in terms of lifestyle and as a city with everything that's going on downtown. Now we're getting a new freeway. All of these things that are happening, Deer District, the new Iron District. So all of that is really impacting Milwaukee positive. So if anything, real estate values in Milwaukee should have gotten closer to the national average. Instead, that gap has actually widened more. So will be interesting to see what's going to happen here over the next 10 years if we're catching up with the national trend. So what can we expect for real estate prices? I have here the home price expectation survey. This is something that Fannie Mae puts together on a quarterly basis, and they are interviewing 100 leading economists, researchers, analysts, the big banks, industry experts. And they're saying, what do you think is the real estate market going to do? What is your bank basing their modeling off for the next 5 years? So this chart looks a little bit confusing, but let me break it down for you. So the black line that you see in the middle, this is the average of all 100 economists and analysts. This is what they're predicting. Basically in 2028, they're thinking the real estate market on the US national level is going to improve by 25%. The blue line that you have on top, those are the optimists. And then the orange line that you have on the bottom, those are the pessimists. Even the pessimists are expecting that real estate values will go up in the next 5 years by a minimum of 10%. Now, you will always find a guy on the internet that will tell you the market is going to crash any minute. But this is the data that basically the big banks are using to build their strategies on. Of course, nobody's going to know what's going to happen in the next 5 years. We could have another war, we could have another pandemic, who knows? But also this is for the US national average. And as we have seen just before, individual states, individual markets can move in different directions. Wisconsin at the moment is outperforming the US market. So we shall see, but we'll keep an eye on the market, that is for sure. What are my expectations for 2024? First of all, super important, mortgage rates will absolutely define what our market is going to be in 2024. So if this trend that we've seen in the last few weeks is going to continue, we are going to see an absolutely crazy spring market. We're also going to see, I think, more inventory because the rate lock effect is easing. So if that has to do with psychology, that sellers are just tired of waiting, or if it's actually rates going lower, probably a combination of both. But we're hopeful that we're going to see a little bit more inventory in 24 as we have seen this year. And lower rates will, of course, also increase demand. It depends how low they're going. Remember the chart with the three colors, red, yellow, and green. If we're going deep into the green, low rates will bring a lot of people back into the market. And the cheaper money will also make them make more aggressive offers because now their affordability is a lot better than it used to be now. And buyer competition will remain fierce based on that. But I do think that the Midwest, not only the Milwaukee market, but the Midwest as a region is probably going to outperform the US national market over the next decade. Economically, we have a lot of things going on in our favor. Unemployment rates are below average, below the national average. So economy is going well. and most of the states in the Great Lake regions are also from a weather point of view more favorable. So there's a lot of things that are going on in the favor of the Midwest. And with that, that's pretty much all I had for you. Thank you very much for watching, and I'll see you next year.